I would like to welcome to the stage Khan Farahani. He is a research associate at Luxor Technologies, and he's going to be giving a presentation on Bitcoin mining since the halving. So please welcome to the stage, Khan.
Thank you, sir. All right. Good morning, miners. My name's Khan. I do research at Luxor Technology, and it's my absolute pleasure to be with you today during the Mining Summit at Consensus 2025 in Toronto to talk about Bitcoin mining since the halving. But before we get into that, I'll go over some basics to set the stage. So for those of you who don't know, Luxor is a software and financial services company dedicated to servicing the mining industry. On the software side, we're well known for our mining pool, which is the first and currently only mining pool in the world to be offering fixed and upfront pool payouts. In addition, we provide a SOC-certified custom firmware, otherwise known as LuxOS. In hardware, we facilitate prime brokerage, secondary trading, and global logistics for ASICs and other hardware equipment. And in financial services, we provide hedging and financing solutions through hash rate derivatives, both in the form of over-the-counter forward contracts and through exchange-traded futures. Now, hash rate index is the information services arm for Luxor, and this is where I spend most of my time, in fact, all of my time, reading and writing about Bitcoin mining. At Hash Rate Index, we provide metrics and research on the Bitcoin network and the mining industry through our website, which houses our data sets and our blog. In addition, we produce a weekly newsletter, a monthly hash rate markets look-back series focused on hash rate derivatives, and of course, quarterly and annual industry reports. We also have a premium offering at Hash Rate Index where members get access to quarterly projection reports, which forecast mining economics, hash price, and its constituent factors in 18-month intervals. And we also provide an API key for members to utilize our data sets. Now, finally, as we get into our mining metrics, I'll quickly touch on one fundamental metric, which will help us understand mining economics, and that, of course, is hash price. Hash price is a term coined by Luxor back in 2019, and what it quantifies is how much revenue a Bitcoin miner can expect to earn from a specific quantity of hash rate they produce. And hash rate is cryptographic computing power, specifically SHA-256 hashing in the case of Bitcoin mining. Luxor's hash price index quantifies the expected value of 1 petahash per second for a full day. So to put this into context, this roughly comes out to around 10 units of S19 JPros, a very well-known mining machine, running for a full day. And this value can be denominated in both Bitcoin and in dollar terms. Now, Bitcoin-denominated hash price is a function that has 3 inputs: the block subsidy, transaction fees, and network difficulty. The dollar-denominated hash price includes a 4th additional factor, which is the Bitcoin price. This metric is very important because what it's doing is it's capturing the combined effects of all of the factors that we just talked about: Bitcoin price, network difficulty, transaction fees, and block subsidy. And all of this is put into a single revenue measurement, which is calculated every 15 seconds. Through this index, we can also observe how these factors influence hash price. So for example, we know that dollar-denominated hash price is positively associated with changes in Bitcoin price and in transaction fee volume, but negatively associated with changes in the block subsidy or with network difficulty. Okay, so now that we've covered all of this, I promise this is the most dense slide we have. After this, it's all visuals and pretty pictures. So 2 things I want to touch on for today's agenda. First, I want to look back on what happened since the halving. And then second, I want to look forward a little bit into the near future to see what we might expect from hash rate markets. So first off, looking back. I think it's safe to say that the last cycle and a bit has been a wild ride. If I were to summarize trends that we've seen in a few key words, I would say ETFs, the halving, institutional adoption, strategic Bitcoin reserves, and finally now, global trade. If we zoom out and take a look at a 2-year time frame spanning from April 2023 to April 2025, i.e. 1 year prior to the halving versus 1 year after the halving, what we see is that Bitcoin price starts at around 30,000 and ends at around 85,000. So that's around a 3x move in terms of price. We also see that the 200-day moving average started at around 20,000 and ended up around 90,000. So that's a 4x move in price action. Safe to say, I think Bitcoin delivered overall. This is exactly what we've all been waiting for, right? But there's the other side of the coin, which is network difficulty. And network difficulty grew in lockstep with Bitcoin price action. Over the same time period, we see that difficulty starts at 48 trillion and ends at 123 trillion. So that's a 2.5x growth. The average difficulty that miners faced in the year prior to the halving, so this is from April 2023 to 2024, was around 63 trillion. Compare this to the year after the halving, it was 97.5 trillion. So that's a 55% increase in network difficulty. And as we just mentioned, Bitcoin price is dollar-denominated hash price is positively associated with Bitcoin price, but negatively associated with network difficulty. So we have these two factors influencing hash price in opposite directions. The question then becomes, which one was more influential? And as we'll see, it turned out to be difficulty, which reflected on hash price. So we just covered Bitcoin price and network difficulty. Let's now turn to transaction fees. A surprising development we've observed since the halving is a sharp decline in transaction fee volume. Throughout April 2023 to April 2024, average fee collection measured in Bitcoin per block per day was around half a Bitcoin, 0.5 Bitcoin. But throughout the following year, post-halving, this fell to 0.16 Bitcoin, which is a 68% drop. Another way to look at transaction fees is to look at transaction fees as a share of the total block rewards earned by miners. And what we see is that pre-halving, this averaged around 7%. Post-halving, that fell to 4%. And an important nuance here is that I'm actually including the day of the halving, which was April 19th, 2024, in all of my calculations, which means that there's even a slight skew to the upside, given that we saw massive spikes across many mining metrics on the day of the halving. So in reality, transaction fees are even a little bit lower than what you're seeing on this screen right now. Now, as you can see, there are also other intermittent spikes driven by alternative on-chain activity. But overall, this dry fee market environment has diminished miner revenues. And an open question that I would pose here to the audience is, could this be a structural change? Are there any potential reasons behind this apparent lack of block space demand that we see? And I believe that the next panel will be touching on this, so I'm looking forward to find out more about that. Now, bringing all of this together as a result of everything that we've just covered, averages for both dollar-denominated and Bitcoin-denominated hash price took a pretty big hit, falling by 36% for the dollar-denominated and 69% for the Bitcoin-denominated hash price between April 2024 to April 2025. Pre-halving, dollar-denominated hash price averaged around $81 per petahash per second per day. Post-halving, this was $52. And for Bitcoin-denominated hash price, we went from around 223,000 Satoshis per petahash per second per day down to around 69,000. So ultimately, this steep decline in hash price compressed mining margins, especially for operations that relied on spot pool payout rates at the time. And what do I mean by this? This is exactly what I mean. What we have here is a hash cost table in reference to the average pre and post halving hash price values we just talked about. So the $81 versus the 52. Let's walk through what this table is showing. So essentially, this table shows the cost associated with running a mining operation for a single day, based on a certain combination of power price and fleet-wide efficiency. Now, a nuance here is, this is a simplifying assumption that I'm making. I'm assuming that all of the operating expenses for an operation are driven through power price, i.e. electricity. In reality, there are many costs beyond electricity that go into running and maintaining a mining operation, but this gets us 80% of the way there, and it demonstrates the concept well. So on the left-hand side, we have efficiency measured in joules per terahash, ranging from 38, which is the worst, all the way down to sub 10 joules per terahash, which is the best. By the way, over the weekend, I added rows to this table, given news releases and developments in ASICs in order to future-proof my spreadsheets. So the hardware market is moving quite fast. And at the top, we also have our power price, which is denominated in dollar cents per kilowatt hour. So these are the two dimensions that we're looking at in this table. Now, each cell in the table indicates how much it costs to produce 1 petahash of hash rate at a day, at that given combination of power price and fleet efficiency. And then the color code is comparing that value to our reference hash price, which is on the top left. So in this case, we're looking at the pre versus post halving hash price. So the impact of the halving is clear. What we see is that the green space has shrunk. Mining margins have been squeezed, right? Hash price gave us the revenue side, hash cost is giving us the cost side, and the difference between the two is our mining margin. So what this means is, in order to justify hashing after the halving, operators either need to improve their fleet efficiency or they need to find cheaper power. And if you want to remain competitive in the long term, as a miner, what you need is high efficiency and or low power rates, ideally both. And of course, we see the impact of these developments and changes in mining economics which eventually reflects onto the hardware market. And the way we can see this is by observing changes in ASIC prices. Our ASIC price index reflects the current price, which is expressed in dollars per terahash, of a wide range of Bitcoin mining machines grouped into efficiency tiers. So what we do is we categorize ranges of efficiencies into 3 tiers: under 19 joules per terahash, between 19 to 25 joules per terahash, and then between 25 to 38 joules per terahash. And then we monitor price changes for these buckets over time. So this gives us an idea of pricing information at the group level. In addition, our premium members also get access to pricing information at the machine level, specifically weekly changes in prices for specific units and conditions, whether it's new or used. And this information is derived from secondary market transactions, which take place on our hardware market. The machine level price information, I think, is especially relevant for professional mining companies who are making ASIC purchase decisions. And we're showing here some bid-ask spreads for a couple of mid-gen S19 series machines, in addition to some of the newer gen S21 series machines. Now, changing gears to financial markets, let's take a look at forward markets. Personally, these next few slides are my favorite visuals in Bitcoin mining because they truly tell 1,000 words. And it might look complicated, but it all boils down to one single thing, and that is expectations versus reality. This is what hash rate forward markets are all about. What people thought was going to happen versus what actually transpired. And this is what we're taking a look at right now. So keep this in mind as we go along. 2 elements in this chart to focus on. The first is a series of dotted lines, which you see going from left to right. Each of these represents a month of trading activity in the Bitcoin-denominated hash rate forward markets, and it ranges from 1 to 6 months out. So for example, at the very left, you see a dotted line for the December 2023 forward curve. What it's showing is trading activity for contracts ranging from December 2023 all the way out to May 2024. The next forward curve, the January 2024 forward curve, shows contracts from January 2024 to June, and so on. So we have these 6-month intervals, which we're showing with the dotted lines. This is how it works under the hood, but let's bring it back up to a basic high level. Essentially, what this chart is telling us is it represents the market's expectations on where they think hash price will go. So that's the insight that we can draw from observing forward markets. It gives us an indication of expectations. And what we see here clearly is that since the halving, actual Bitcoin-denominated hash price was consistently lower than what the forward market expected. And what this translates to is that either network difficulty grew faster than they expected, or transaction fees were weaker than expected. And we know that these headwinds significantly compressed hash price. So the conclusion, what this chart is telling us is, following the April 2024 halving, the forward market participants were met with surprise. The Bitcoin-denominated forward market consistently overshot in terms of where they thought hash price would be versus where it actually landed. Now, if we take a look at the other side, the dollar-denominated forward market, the story was a little more complicated. And the reason was because the post-election period in the US, between Q4 2024 to Q1 2025, saw strong Bitcoin price action, which pulled up dollar-denominated hash price above forward market expectations. And also more generally, if we go back and forth between these two, you can see that there's a significant difference between the mismatches in expectations versus reality in the two markets, dollar-denominated versus Bitcoin-denominated. The reason is because dollar-denominated hash price includes this fourth volatile factor, which is the Bitcoin price. So in conclusion, the dollar-denominated forward market was a mixed bag, but generally undershot in terms of where they thought hash price would be, because Bitcoin rallied and broke through this $0.1 million price point. Ultimately, these two misalignments that we saw in both markets is what directly influenced performance, and this is where the opportunity lied for market participants. So, this is that opportunity summarized in one picture. As we mentioned, Bitcoin hash price declined more sharply than expected. So this difference between spot and forward Bitcoin hash price revealed the optimal trade, which was to sell forward in the Bitcoin-denominated forward markets. Why? Because what this would have allowed is for a miner to essentially guarantee a Bitcoin-denominated hash price before difficulty continued its sustained climb, which means that the miner would have effectively mitigated the subsequent decline in hash price. Now, you could even go a step further and do this consecutively, continuously. Enter into a series of forward selling contracts, which effectively locks in your hash price for an extended period of time. And that's what this chart is showing right here. What we're looking at is the performance results of different rolling hedge strategies relative to spot mining from April 2024 up until, from May 2024 to April 2025. And clearly, these rolling hedge strategies delivered strong results. What we can see is that long duration Bitcoin-denominated forward selling, particularly doing this further out, for example, 4 or 5 months out, delivered the strongest results. A 5-month rolling hedge, for example, would have earned a Bitcoin miner around 20% more Bitcoin throughout this period. And the reason is because essentially what they're doing is they're hedging away the network difficulty and transaction fees, but still maintaining that long exposure to Bitcoin price. So the Bitcoin denominated forward consistently overpriced, which means that buyers overpaid and sellers underpaid. And this is why forward sellers came out to be the winners. That was a lot. So let's now look forward into the near future. Key trends that we're keeping in mind for 2025 and beyond. The first is the race between Bitcoin price and network difficulty. As we just mentioned, we saw what this relationship looks like. If Bitcoin price continues to increase in the near future and outpace network difficulty, as we've seen in the past little while, then 2025 can be very lucrative for Bitcoin miners. But at the same time, if price action stagnates and network difficulty continues to grow, we know that hash price is going to get pulled down. The second key trend is transaction fees. As we mentioned, transaction fees right now are quite dry, but block space demand is unpredictable. So this could be a wild card. It's an open question. And finally, the third piece is mining markets going mainstream. We see that public policy is becoming a defining force in Bitcoin mining. Decisions around trade and strategic Bitcoin reserves will also be a major factor going forward. And home mining is also gaining resurgence as well. So safe to say that there's room for growth in the mining space. Big question, when Zeta? So this chart projects our base case trajectory for Bitcoin's hash rate and hash price throughout 2025 and into 2026. This is the premium projection report that we mentioned earlier in the beginning. And what this shows is we anticipate the network to cross the 1 Zeta hash milestone around fall of 2025. Sometime in September, it could be as early as summer or winter, pending market conditions. And our forecast also estimates hash price to range between $35 to $45 throughout this period until October 2026. We can also take a look at the forward market to see what the next 6 months looks like. As of earlier this week, Luxor's hash rate forward market was pricing in an average hash price of around $52 per petahash per second per day, or 49,000 Satoshis. Finally, as we come to a close, I wanted to finish off with some fun financial modeling. So what I've done here is create a hypothetical fleet to showcase how we can take our mining operation even one step further. So the setup I have here is a 1 exahash operation with a 5 cent per kilowatt hour power cost. I have 5,000 units of S21s running LuxOS firmware, and I've accounted for a 2.3% dev fee, and I've waived the pool fee away. What I'm doing is I'm forecasting 6-month cash flows and profits up until November 2026, covering both of the forward-looking scenarios that we just showed. So the base case trajectory and the forward curve. Now, I touched on firmware. To summarize, firmware is essentially software to jailbreak your mining machine, which unlocks its full capabilities. It allows you to change the machine parameters and to fine-tune it so that you can optimize for hash rate or efficiency. It gives you more control. By utilizing firmware, we can actually influence the hash cost of our operation, that table that we saw earlier, and we can make that variable. So that allows us to either change our cost side or our revenue side, and to essentially maximize our mining profit margin. And results for this could be upwards of around a 10% increase in net profits, which is driven by either becoming more efficient, so spending less money on your electricity expense, or producing more hash rate, gaining more revenue for the product that you're producing. So I know that was a lot. We covered a ton of information. Miners have a lot of problems to solve, a lot of optimizations that they're trying to figure out, spanning from hardware, finance, software, and also power. If your mining operation already has a hash rate hedging strategy in place, in addition to hardware procurement, and you're utilizing firmware, you're already a few steps ahead of the game. But pairing this with a sophisticated power strategy, we believe, is what truly defines what modern mining looks like. And with that being said, I thank you all for your time. I hope you found this to be valuable.